Got to start with Jay Powell. Wall Street took his comments yesterday as opening the door to a rate cut. Do you think that door is open?
I think it's early to make a judgment on that. We're going to be very vigilant about understanding these heightened trade tensions, see if they feed through to the economy. Most importantly, see if they persist. And so I think it's too soon, though, to make a judgment as to whether we might or might not take an action. I'd rather be patient here and let events unfold a little bit more.
Well, investors have priced in 3 rate cuts, and Wall Street economists over the weekend basically joined the consensus that you're going to cut rates. You've been in the watch and wait camp. What would tip the balance for you? When would you think that you need to make a decision?
I would need to see some evidence that there's a deceleration or further deceleration in the economy. We've expected that growth would slow from 18 to 19, but we're still growing above trend. We're still seeing a tightening in the labor market. And our Dallas Trim Mean, which is our measure of core inflation, is now at 2%. We think we'll end the year around 2%. So I would need to see some evidence that there's a worsening in those trends. We may well see it. I'm on watch as to whether we see a further deceleration, but that's what I'm watching for.
The data are lagged. Cost benefit, what's worse, cutting too early or waiting too long?
So it depends on where you are in the cycle and what our stance is. And my own assessment of our stance is we're in the neighborhood of neutral right now. So if we were to cut, that would be me making a judgment that we need to add stimulus to the economy. That might ultimately be a judgment I need to make. But if, on the other hand, you've got a restrictive stance and you decide to cut, that's something different. Or if you're highly accommodative, it also is a different judgment. But right now, we're pretty much of a neutral setting. And the question is, should we be adding stimulus to this economy? That's a question I'm asking. I'm open-minded about it. I think the risks to the downside in the last 5 or 6 weeks have increased because of these heightened trade tensions. So I'm watching it very carefully. But that's the judgment and that's the question I'm going to be asking.
Well, they say that the Federal Reserve decides when to raise rates, but markets decide when you're going to cut them. How much pressure do you feel from markets right now?
I've spent my entire career in the markets, as you know, and I've learned that markets can change on a dime. For example, there's been a dramatic change in the markets since May 1st, or approximately May 1st, last 5 or 6 weeks. And as we've seen, you could see a dramatic change in a different direction over the next 5 or 6 weeks. For example, what's happening to the Treasury curve, I think, is very much in response to heightened trade tensions. And some of those decisions or some of those tensions could be reversed in the next several weeks. So I've learned to watch markets, but I don't want to overread or overreact to what they're saying, and because they can change on a dime.
Well, what are CEOs in your district telling you about what they see in the business climate, and what are they asking you to do?
So the biggest issue for businesses today, and I think this is the vulnerability for the U.S. economy, it's not the consumer's in good shape. It's for businesses. There's a high level of uncertainty, and businesses are using logistics and supply chain arrangements heavily to remain competitive. They don't have much pricing power. Technology and globalization have limited their pricing power, so they're using some of these other techniques to manage their costs. And what they're seeing is a lot of uncertainty as to how they're going to be able to do that. And I think these recent threats against Mexico have further put more uncertainty into their minds. So what do businesses do? What they're telling me they're doing is be more careful, hold off on CapEx, be more cautious. So I think this is having some chilling effect. I think the businesses will also remark cost of capital is historically low, access to capital is historically high, and so they're not that sensitive for many of the businesses I talk to, other than, say, the home builders. They're not as sensitive to the policy setting as they are all these other uncertainties in managing their business.
You mentioned the Mexico tariffs. No district would be more vulnerable than the 11th district, yours. What would be, have you modeled what the impact would be on your district and then on the national economy?
Yeah, so we're, by our estimate, we're probably a third of U.S. trade with Mexico. Texas is the largest exporting state in the United States. We've taken a number of looks at it. I don't even want to throw out statistics because I'm still hopeful that there won't actually be a follow-through on these tariffs. And the reason I'm hopeful is this is a very different trade relationship than the one with China. This is substantially an intermediate goods relationships which allow U.S. companies to manage their logistics and supply chains, be competitive, domicile in the United States, and it's allowed North America and the U.S. to take share from Asia. So as opposed to the trade relationship with China, which is primarily a final goods deficit, and so it is so overwhelmingly in the interest of the U.S. to have a strong trading relationship in North America with Mexico and to some extent Canada, that I don't want to go too far expecting that we're going to do something that was going to further jeopardize that relationship. It's so clearly in our interest to have a strong trading relationship with Mexico.
Well, we have seen the impact, just as you say, in uncertainty.
Yeah.
How do you think the Mexicans would react? You speak to their policymakers a lot.
You know, we're very close to senior officials there ahead of the central bank. So it's not been as reported as much in the press, but over the last 2 years, Mexico is the one country in the world that's fighting an inflation problem. They've had a very volatile currency. They've raised their domestic interest rate substantially over the last couple of years. I think there was hope that there would be some stability with USMCA. This just further puts volatility in their currency, makes it harder to manage their economy, and we see slowing in economic growth in Mexico. They're actually slipping. They've got a new president. There's uncertainty with that. So it's a very challenging time in Mexico.
You put it all together. What impact has there been on your economic outlook for the rest of this year?
So our forecast for the year still is in the neighborhood of 2.25% GDP growth. It could be a little higher, could be a little lower. Still think the labor market's going to tighten. We still think we're going to end the year in the neighborhood of 2% on core inflation, Dallas Trim mean. I think these recent events have raised the risk to the downside. And so I'm much more vigilant, I'm much more cautious about how events are going to unfold. And the question is, are these tensions going to persist? And if they do, they're likely going to have some negative effect on our outlook. But I think it's a little too soon for me to make a judgment about that. But we're on heightened alert as a result of these tensions.
You're here in Chicago for a Fed Listens conference on the monetary policy framework. Is the framework broken? Do you need to fix it?
No, I think our framework is working reasonably well. There are a couple of big issues, though, that we've been talking about. One is inflation has been running for the last 8 or 9 years, not completely, but for a lot of that time below our 2% target. I think a lot of that has to do with technology-enabled disruption, globalization, i.e. structural trends. Should we be revisiting elements of our framework so that we can be more confident that we're meeting our 2% target and that we're anchoring expectations around 2%. And then the other big issue, which is somewhat related to that, is as well as the economy's performed over the last number of years, there's a number of underrepresented groups that have not fully participated in this recovery. That may be due to educational attainment, other impediments in their lives that make it harder for them to join the workforce and stay in the workforce. And I think running a somewhat hotter labor market may help those groups get in and stay in and help create somewhat more inclusive growth in this country. And I think that's another issue that we're actively talking about. Can you generate inflation? If you cut rates, say, would that raise inflation? So you've heard me say before, the monetary policy has a pretty potent effect on the cyclical aspects of inflation, tightness of the labor market, other elements of the cyclical elements. The part that might be a little less susceptible to monetary policy are these structural drivers of, again, technology-enabled disruption, globalization, which are limiting the pricing power of business, improving the negotiating leverage of consumers, making it harder for businesses to raise prices, even if they have wage increases. And so I think it's muting the inflation effect. And so I think this dynamic is one we just need to take into account as we think about monetary policy.
Is there any suggestion, and there have been many of them made, for policies you could adopt that you find intriguing or interesting?
Well, I'm open-minded on all these proposals: nominal GDP targeting, elements of price level targeting, inflation averaging. I think the key for me is, do we want to come out of this framework review saying there are 2 or 3 new factors we want to take into account, or we want to update our framework, for example, to take into account average inflation over a period of time? It's one thing to take those factors into account. It's another thing to make a commitment or create a rule that would bind future actions. I'm reluctant to bind ourselves to future scenarios that we can't predict, but I am in favor of altering, probably updating our framework to take a few additional factors into account, which I think may serve us well in meeting our dual mandate.
Are you worried at all that the Fed's raised expectations for what's going to come out of this process, and you may disappoint the markets?
I think we have to be careful to communicate clearly that I think it's a healthy thing to do a framework review. I don't think it should be a one-time thing. I think it's something a good organization does regularly. But because we haven't done it in a long time, it may raise some expectations. But I think we're going to have to just communicate what we're thinking and how we're doing it, so we sort of balance how we're going about this.